Today, and for this month's YouTube episode, I'd like to discuss something related to Paul Volcker, the former Fed chair in the late 1970s and early 80s, as well as our current Fed chair, Jerome Powell, and talk about the very different tactics they took during inflationary periods of time. And as an example, when Paul Volcker came in the late 70s and inflation was running in pretty significant double digits, he actually raised the Fed funds rate, which right now is at about 5.33%. He raised the Fed funds rate to about 750 basis points above the inflation rate. That's a huge number. And actually in the Forbes article that has just been submitted, which will be published later this month, I talk about what that figure actually is. Even in our research highlight, also talk about what this figure is. And by November 30th of 1979, the effective Fed funds rate had been raised to 13.96%. Meanwhile, the 10-year U.S. Treasury was only at 10.38%. By March of 1980, U.S. inflation had peaked at 14.76%, while the effective Fed funds rate had been raised even higher to 19.85%. So, here we are complaining about a 5.33% Fed funds rate. Imagine being in March of 1980 and seeing a 19.85% Fed funds rate when inflation is only at 14%. Only at 14%. Meanwhile, when Powell was addressing our inflation issue, instead of taking the Fed funds rate significantly above the rate of inflation, we were about 500 basis points below the rate of inflation. And I provide some context for that as well. So when the inflation rate peaked at 9.06% in June of 22, the effective Fed funds rate stood at 1.58%, a full 748 basis points below the rate of inflation. And meanwhile, it had been as much as 509 basis points higher under the Volcker years. So this is fundamental to understanding the very different scenario that we are in today in terms of the inflation backdrop, which certainly is not as virulent, not as ugly as it was back in the early 80s. But certainly has been a shock to the system nonetheless. And the cumulative increase of inflation has been colossal, more than 20% over the past 3 years. And so when you have this amount of cumulative inflation over a very short period of time, thinking about a federal funds rate that goes down precipitously seems less likely, since that could also then spur on additional inflationary measures. Keeping interest rates higher and actually seeing and witnessing higher interest rates in the marketplace is very normal. As a matter of fact, the Forbes article title is, "For decades, the Fed funds have remained higher than the inflation rate, and this may happen once again." And we actually saw for many years, more than 2 decades, that the Fed funds rate was actually higher than the rate of inflation. And we see averages like 4.65% is the average going back to the 1970s for the Fed funds rate. 30-year mortgages at 7.67% is the average. We're kind of near that right now. The average spread between the 10-year Treasury and the 2-year Treasury was and has been around 88 basis points. Just call it 100 basis points, 1% between a 10-year yield and a 2-year yield. Right now we're inverted still, meaning short-term rates are higher than long-term rates. And the average rate for the 10-year Treasury has been 5.87%. we're getting closer back down to 4 again. So there's quite a bit of historical perspective that we can really take into consideration, knowing that interest rates are certainly not very high relative to history. Inflation certainly is not peaking to ungodly levels, and seems to be somewhat under control. But this is where things get tricky, and so watching how the Fed continues the roll off of their federal balance sheet, the Federal Reserve balance sheet, that is going to be very informative. There's also another dynamic at play, which is that foreign buyers, which have been a huge component of the U.S. Treasury market, have not been as impressive in their buying. And so this is something to continue to be mindful of when a major buyer exits the market. So you have not only the Federal Reserve exiting the market as a buyer, they have been the primary buyer, but also now foreign buyers exiting the market and not being as virulent in their buying. That's decreased demand. So anytime you have decreased demand for something, prices tend to go down. And in the bond market, when bond prices go down, yields tend to go up. So there are these market dynamic natural supports available right now in the marketplace that actually support higher interest rates. So even if the Federal Reserve reduces the Fed funds rate, which they may do, maybe they'll do that next year. And they'll do that because unemployment starts to rear its ugly head and starts to look extremely scary, and they're going to react and create some more easing within the system, certainly within the Federal Reserve and the banking system. However, don't think that naturally correlates that interest rates in the market, the 10-year, the 5-year treasuries, corporate, intermediate corporates, long-term corporate bonds are going to move in lockstep with what the Fed funds rate is doing. Because historically, we don't see that. Historically, we see that interest rates can actually be sustainably higher, even though the Fed funds rate comes way down. You can see marketplace rates remain elevated. And that's normal. So take that into consideration as you examine your bond portfolios. If you're a financial advisor, make sure you understand your convexity and your duration risk within the bond portion of your portfolio. And certainly we're always happy to consult with you if you'd like to engage in this discussion further, whether as a direct client or as a financial advisor in our network. We're always happy to have this discussion in detail. Please let us know. You can contact us at alignwealth.com. That's ALIGNE wealth.com, or give us a call, 310-795-0622. Thank you so much for joining me this month, talking about interest rates, historical interest rates, the Fed funds rates, inflation, and look forward to next month. Happy Thanksgiving.